Chapter 14, Corporation Accounting. Introduction. Chapter 14 explores the concept of owner's equity and retained earnings in corporation accounting. It discusses the different forms of business ownership, including sole proprietorships, partnerships, and corporations, and how they account for equity transactions. The chapter also covers the characteristics and functions of the retained earnings account, as well as the restrictions and appropriations that can affect it. Additionally, it explains the process of securing equity financing through the issuance of stock and the recording of transactions for the issuance and repurchase of stock. Learning objectives. By the end of this chapter, you should be able to 1. Understand the differences in accounting for owner's equity and retained earnings in different forms of business ownership. 2. Explain the characteristics and functions of the retained earnings account. 3. Recognize the restrictions and appropriations that can impact retained earnings. 4. Analyze and record transactions for the issuance and repurchase of stock. Key points. The process of forming a corporation involves several steps, resulting in a legal entity that can issue stock and raise capital. Corporations have two classes of stock, common and preferred, each with its own characteristics and rights. Stock can be issued for cash, property, or services, and the accounting treatment varies depending on the type of stock and the value received. Dividends can be in the form of cash, property, or stock, and they impact the retained earnings account. Treasury stock is the company's own stock that has been repurchased, and reissuing treasury stock affects the additional paid-in capital and retained earnings accounts. Stock splits can be used to adjust the stock price and increase liquidity. Real-world application. Understanding the concept of owner's equity and retained earnings is essential for anyone involved in corporate accounting or financial management. It allows business owners and managers to assess the financial health of their company and make informed decisions about dividend distributions, future expansion plans, and risk management. By analyzing the changes in stockholders' equity accounts, they can track the company's performance and communicate it effectively to stakeholders. Additionally, understanding the process of issuing and repurchasing stock is crucial for companies looking to raise capital or manage their ownership structure. Conclusion. Chapter 14 explores the accounting for owner's equity and retained earnings in different forms of business ownership, with a focus on corporations. It highlights the differences in accounting methods and the importance of retained earnings as a key component of earned capital. The chapter also discusses the process of securing equity financing through the issuance of stock and the recording of transactions for the issuance and repurchase of stock. By understanding these concepts, you will be equipped to analyze and manage the financial health of a company and make informed decisions about equity transactions.